The biggest mistake new investors make isn't picking the wrong stock, the wrong neighborhood, or even the wrong timing. It's something far more invisible, and it's bleeding them dry before they even realize the wound is there. We're talking about a mistake so common, so quietly devastating, that it has cost everyday investors tens of thousands, sometimes hundreds of thousands of dollars, and most of them never even saw it coming. The culprit isn't bad luck or a bad market, it's emotional decision-making dressed up as strategy. When you feel confident, you go big. When you feel scared, you bail out. And somewhere in that cycle, the market calmly takes your money and hands it to the person who didn't flinch. Think of it like driving with your eyes glued to the rearview mirror. You're so focused on what just happened that you completely miss what's right in front of you. New investors constantly chase yesterday's winners, pouring money into assets that already had their run, then wondering why they bought at the top every single time. The data here is not subtle. Studies show that the average retail investor underperforms the market by nearly 1.5% to 2% annually, simply due to buying high and selling low on emotional impulse. That gap, compounded over 20 or 30 years, isn't a rounding error, it's a retirement. There's also a dangerously seductive myth that you need to be fully convicted before you invest. That hesitation means you're not ready. But the irony is that the investors dripping with confidence are often the most exposed, while the cautious, methodical ones quietly build wealth in the background. Look at the housing market boom of 2006 or the crypto frenzy of 2021. In both cases, ordinary people poured life savings into assets because everyone around them seemed to be getting rich. Then the tide went out, and as Warren Buffett famously warned, we found out who had been swimming without a swimsuit. Here's what history keeps trying to teach us. If only we'd listen, markets cycle, corrections happen, and the people who survive and thrive are the ones who size their positions wisely, not the ones who bet the house. Every single boom in history has felt different, special, and this time it's real. And every single bust has felt like a surprise, even though the pattern was always there. One of the most overlooked lessons is position sizing, the unsexy, unglamorous discipline of never letting one bet define your financial life. You can be right about a trade and still lose everything if you sized it like you were absolutely certain. Because certainty in investing is a hallucination. The misconception we need to kill right now is that patience is passive. Sitting on your hands feels lazy, but discipline in action is one of the most aggressive wealth-building tools you have. The market rewards process, not passion. And it absolutely does not care how badly you want to win. So what do you actually do with this? You build a framework before emotion ever enters the room. You decide in advance what you'll buy, how much, at what price, and when you'll exit, so that when fear or greed shows up, they find a locked door. The strategy has to exist before the feeling does, or the feeling always wins. The practical lesson from every market cycle, every crash, every irrational bubble is almost embarrassingly simple. Diversify, size conservatively, invest consistently, and don't touch it. The boring investor with a boring portfolio who never panicked in 2020 is now sitting on gains the adrenaline junkie day trader can only dream about. At the end of the day, this isn't really about markets or assets or interest rates. It's about you, your psychology, and whether you can build a system that protects you from yourself. Discipline, sizing, and consistency aren't just investment principles, they're the whole game. And the sooner you accept that, the sooner the game gets easier. The beautiful part is that knowing the mistake exists is already half the battle. You are now ahead of the version of yourself that would have walked blindly into it. Whether markets go up, down, or sideways, a rational, prepared investor finds a way to be okay with any outcome. And if you're ready to stop making expensive emotional decisions and start building real, durable wealth, whether through real estate investing, home contracting, or finding the right lenders, check out our links in the description below, and let's get you started on the right foot.